Crude oil trending higher following a recent sell-off amid demand concerns. And where is oil headed now, and what are the implications? For more on this, we bring in Fernando Valle, Bloomberg Intelligence Senior Energy Analyst. Thanks for joining us here today, Fernando. Crude oil dipped below $100 per barrel versus WTI. Now it's back above. What is the trading range for oil? Because I think that's one of the number one concerns that relates to the price of gasoline.
It's a good question right now with all the volatility that we've seen over the past 3 to 4 months. I think there's some downward pressure still in the short term, as you brought up the difficulties with inflation in the UK, but that's being felt around the world. And when we look at how hawkish central banks have been, we could see more pressure on oil prices globally, as there's not a lot of ways for them to increase supply. So central banks are trying to curb demand as a way to control the effects of energy on inflation. So we think there could be some downward pressure in the short term, but we think long term we have a supply imbalance that won't be solved unless we have higher prices for longer.
Yeah, and certainly it has been very lucrative for the oil companies. We got some updated numbers from Shell today, Fernando, forecasting a profit margin from crude refining nearly tripled in the second quarter. I mean, it's worth pointing out these numbers from $10.23 a barrel to $28.04. How much more upside is there?
Yeah, Exxon similarly guided to refining margins over twice as high as was expected by consensus, and $5 billion higher than it was in the first quarter. So it really bodes well for the refining system. And the upstream side, the oil producing side of the equation, also added over $3 billion in earnings in 2Q as guided by Exxon. So we think there's still room, especially on the refining side, because we haven't really solved the equation on the refinery system. We just had inventories numbers today for the U.S., and we saw large drops for both gasoline, diesel, and jet fuel. And because we haven't really figured out how to get more supply into the East Coast, for example, because of all the refinery shuttings over the past 2 years, we think those margins are going to remain elevated, especially with the higher cost of refining in Europe, given the higher electricity prices and the sanctions against Russian oil.
Well, and I wanted to ask you about Russian oil just next. There have been talks by various leaders around the world that Russian oil should be capped at $50 to $60 per barrel, and maybe that would have some ameliorative effect on the price of oil. But we know that dark supplies of oil always find a home. I'm just wondering how realistic that is, and would that actually have any effect on the price of crude?
It would be difficult. I mean, Russia would seek the highest price it could get, and that would be countries that don't follow Western sanctions, be it India, Pakistan, China. They would buy that crude, and certainly at a higher price than $40, $50 a barrel. The sanctions already make it much more difficult for you to insure a tanker leaving Russia. So I think it's more posturing than an effective policy to curb Russian imports. And, it's a little bit of a game of chicken as well, because Europe really needs Russian natural gas, especially during the winter months. And even though they're trying to fill their inventories as high as they can, a cold winter could be really catastrophic if Russia decides to cut supply to Western Europe. And in that case, there's really not much the U.S. can do, because we don't have the export capacity to bring liquefied natural gas to Europe just yet.
Fernando, what does this all mean for renewables? I mean, we have a tendency to talk about this being one or the other, but it certainly feels like if you look at a company like Shell, for example, they are moving on two tracks. On the one hand, talking about increasing drilling, but also investing in something like a hydrogen fuel plant. I mean, is this kind of what we're going to continue to see as especially European nations try to find an alternative they still haven't been able to fill coming in from Russia?
Yeah, it's very interesting. I think because the U.S. majors, Exxon, Chevron, Conoco, and the Europeans, BP, Shell, Total Energies, are taking very different approaches to the transition. And we've seen that the renewables can't carry the load just yet, The electricity price in Europe in January was significant because there wasn't enough renewable generation and natural gas was over demanded and there just wasn't enough supply. So what is interesting to me is potentially the use of carbon capture and the development of that technology over the next decade or so, because that would be a way of using existing infrastructure to reduce our carbon emissions. There are a lot of investments, not just on the US side, but also on the European side, to capture that carbon, lower our emissions, and continue using the existing infrastructure related to fossil fuels, but in a much cleaner way.
And Fernando, we got time for one more. I want to ask you, and this is for the consumer, people who are buying gas out there. I've been following crude oil prices for about 20 years, and I've noticed that when there's a big drop in crude oil prices, gasoline prices, especially at the pump, they don't follow initially. In fact, there's several weeks to a month or two lag sometimes. I'm just wondering if you could break that down for us.
Yeah, absolutely. It takes a while for that to filter through to the consumer. And there are several reasons. One, refiners buy that crude 30 to 45 days in advance. And then it still needs to be refined, taken to a wholesaler that then gets to the retailer. So there's a filtering through process. And it's not to say that it will take 2 months. And when there are such volatility, usually the wholesalers will take a little bit of time to pass it through, make sure that they are buying at the correct price and passing that through so they don't take a loss. And the same is true of the retailers. But with the current volatility and we've seen the reduction in oil prices, there's also been a reduction in crack spreads, the refining margin on fuels. So I expect to see lower pump prices over the next month or so, potentially even below $4 a gallon in some parts of the U.S.
You got a lot of ears perking up right now. Certainly that relief can't come soon enough. Fernando, it's good to talk to you today. Fernando Valle, Bloomberg Intelligence Senior Energy Analyst.